if somebody's talking to you about gold or silver, there is 2 red flags that you are about to make a major financial error. And that is if you hear self-directed IRA. And the second one is if you hear somebody say paper shares. And so if you actually take out this period of time of like gold standard plus, coming off the gold standard.
Yeah.
You say, how has gold done since? Gold's beaten the S&P 500. How is that possible? So all of a sudden, life can change. That long-term money becomes mid-term or short-term money relatively quick. And that's why it's important to have the diversification of the asset classes, right?
Information presented on this program is believed to be factual and up-to-date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey, welcome back to another episode of the Tall Oaks podcast. I'm your host, Brandon Ducharme, and joined today once again by my colleague, Carissa Bertrand. And in the continuation of our series, talking about the 5 asset classes to help manage this kind of secular debasement period of history that we're in, which, by the way, just to reiterate, is not about debasement this year or this week or this quarter or this, last 2 years, but this general idea that there's been a fundamental shift in the economy, the economics, the way the world works and functions, the adoption of fiat currencies en masse. That's something that happened over decades, and we're now in this period where, at a minimum, the Fed says, hey, there's going to be 2% inflation per year, right? They have an inflationary target. Mm-hmm. So by their own definition, over time, they have an interest in debasing the currency. And there's a number of economic conversations to have around this of, kind of the Keynesian framework. Inflation greases the wheels of the economy. And, in these series, we don't really care to get into the political, whether it's morally right from a political perspective or not. That's not our job, right? Our job as advisors is to help our clients, preserve and grow capital across time so that they can reach, retirement on time in an anticipated comfortable manner. Yeah. Or, get capital across time, preserving it, growing it so they can pass it throughout generations. So that's what we're here to do and talk about. And today, the asset that we're focusing on is precious metals, or the asset class, rather. And so just to kick that off and define sort of what it is that we're talking about, if you're thinking gold right now, you're like 95% of the way there, maybe 90. Gold is going to be probably the largest allocation and the most commonly talked about thing in precious metals. The second is going to be silver. And most people know that. And most people will call silver. Did you know it used to be called like poor man's silver or poor man's gold?
Yeah. Yeah, I've heard that.
And it's because it's a smaller denomination, really, right? Like if you think about a quarter used to be silver, whereas a gold coin was always like $20, right? So a smaller denomination that makes it easier to sort of transact amongst each other in kind of daily life, right? It's kind of like it's kind of like when people say like, what am I going to do? Buy a cup of coffee with Bitcoin? It's such a hassle to transact one thing. They sort of used to have that kind of problem with gold, right? Like, what am I going to do? Buy a loaf of bread with a whole gold coin, Yeah. And so you had silver, right? And silver was, smaller, more easily divisible, but you didn't have to have a fleck or a little fleck of it or a shaving or something like that. But there's a couple more, most notably in the precious metals category. Aside from gold and silver is going to be platinum and palladium. Platinum is actually more rare than gold, for context, which is why, if you think about it just intuitively, like if you stop for a second and think about like a record, when a record goes, Taylor Swift releases, and I'm not a music person, but for demonstrative purposes here, like if Taylor Swift releases an album, right, and it's super popular, does everyone say like, oh, I want gold?
No, I went platinum. It's a platinum record.
Yeah. What about like a service package you buy, if you're down at the dealership and you're buying a service package or a warranty for that new car, they say, hey, we got we got the silver package, the gold package, and the
platinum.
The platinum package, right? So the platinum is kind of actually the rarest, so it's the most desirable, and it actually holds the most value. Yep. Now, from a trading perspective, there's some nuances to understand there, and particularly the demand isn't always there the same as gold. The volatility can be higher, but it is in that group. And the last is the palladium. Mm-hmm. Palladium, most everyone listening to this podcast actually owns some palladium. Just as they actually also own gold and silver, almost for sure. So gold and silver is used a lot in like circuit boards, small electronics, a very minute amount. But palladium, you're not going to find that in your phone. Where you're going to find that actually is in your catalytic converters. And that's why you have these crime waves actually of people stealing like catalytic converters.
That's what they're wanting. I didn't realize that.
It's actually because of the palladium in there. That's what makes them so expensive to replace. That's what makes people want to steal them. They're taking that, they're cutting them open, and they're taking the palladium out of it.
Interesting.
The other ones, you've got iridium, osmium, rhodium, and ruthenium.
Would you consider copper as well?
It's not a precious metal. It's an industrial metal.
You're right. Okay.
So the thing that makes the unique characteristic that makes precious metals precious, if you will, is their general rarity, right? So copper's not exactly rare. It's not hard to find.
Right. There's not that intrinsic scarcity like there is with these others.
Yeah. The biggest thing though is that they don't corrode, right? So like silver, you can get some varnish on it, but you can just wipe it off. Yeah. If you've ever seen an old copper pipe and it turns like green and kind of breaks down, that is if you think about what you want your money to be, you don't want your money to be something that can like rust and break down and corrode or, and so that's why these precious metals have been utilized as money throughout history, right? I mean, the entire history of the world, essentially, right? Certainly throughout all of recorded history. And so if you're, in Mesopotamia, right? Like your currency could be rice or corn or lamb meat or whatever, right? What are the problems with those?
They're going to go bad.
They have a shelf life. Yeah, they have a shelf life. So you're forced to have to utilize up that resource, right? You have to consume it. And that's why, that's why at one point we were on the gold standard, is because gold is this, and all the precious metals have the same characteristic, is like they don't corrode. So you can put it somewhere. You can put it in a time capsule, right? And 10 million years from now, you could open it up and it'll be one perfect.
Still just as shiny as ever.
Regardless of whether it was at the bottom of the ocean or, buried underground or in outer space, wherever it was, right?
Right.
And so that's why we were, on the gold standard and not the corn standard, right? Like corn's a great resource. You can eat it. There's a lot of utility to it, but you can't store it forever.
Yeah.
Right. And so remember, like money and currency is supposed to be a store of value. Now people will say and talk about what it takes to be a currency or store of value. And one of the things that people will say, in Bitcoin, for what it's worth, gets the same argument against it, right? Is this volatility, this unsuredness of what's it going to be worth? If I have, say, a $20 bill in my pocket, I can go down to the store. Whether I go down to the store today, tomorrow, next month, I generally get about the same thing for $20, right?
Yeah.
And so people say, well, that makes it a good currency, right? Is there this stability to it? Yeah, it's a unit of measure that's relatively stable. What gives rise to this entire conversation is the idea that, well, that's true in the shorter term, and so the volatility is low.
Right.
Right? Is that $20 buying the same exact thing 3 years from now?
No.
5 years from now?
There's that purchasing power difference.
And so zoomed out, it's actually not very stable.
Right.
It's slowly degrading. And so people say, well, yeah, but it's slow enough that you can manage it, right? And so that's what most people do, is they sort of manage their life around it, right? I'm going to go ask for, like you don't go, oh my gosh, the price of milk is up 25% today, or, actually if it was up 25%, you might freak out. But you don't say, oh my gosh, the price of milk went up another 10%. this month, I have to go ask for a raise and they have to give me a raise immediately. I need a 10% raise, right?
Yeah.
Like it's just, you don't have that same kind of volatility in your life that way. But as soon as you start talking about, hey, I'm taking money and I'm putting it aside for use that's not in the next 6 months or 12 months, you want to start figuring out how to protect that purchasing power and that capital. And so you have to look for ways to sort of put that money to work, or protect the purchasing power of it. And precious metals tends to be the idea of storing the value, right? Just more of a savings. Now, because of that component, it gets a lot of flack from academia in finance, or if you think of the more academically focused advisors, if you will, that, they read the historical textbook and they look at the theoretical framework and they say, well, okay, gold, it protects against inflation and it has no yield to it. Yeah. Right. Like if you buy a treasury inflation protected security, a tip, there's a yield to it, right? So you get the rate of inflation plus a little bit of treasury yield, right? And so they say, well, if you want to do that, you should just buy those. Yeah. And not gold. Gold should, over time, just give you back your cash.
It just stores that, like, that value.
Yeah.
Right?
And so what they'll do is they'll zoom out a chart to, like, the late 1800s or early 1900s, and they'll say, see, it just does, like, basically the same as bonds, or even a little, like, worse. It just does a little bit better than cash. And the problem is you're convoluting two periods of time that were very fundamentally different. And that is a world in which there was a gold standard and a world in which there wasn't a gold standard, right? Right. Interestingly, when you went through the first period of interest rate rising, under Paul Volcker after the gold standard, right? In the U.S. So this is the 80s, and Paul Volcker raised the interest rates, and you had inflation in the system. Paul Volcker had to do these interest rate hikes, and anyone that was around back then remembers this, and it manifests itself in today by older people saying, "The first home I bought it with a 15% mortgage," right? Yes. Well, as they navigated that in the U.S. and solved that problem, and Paul Volcker was able to break the back of inflation with utilizing the interest rate policies of the Federal Reserve. The other countries had somewhat of a conundrum, right? You're on this dollar standard, and the U.S. just proved that this fiat currency thing isn't going to just break right away. And so then you have, in this initial period, you have everyone saying, well, what are we to do with all this gold we own now? Right? Like, man, we own gold as money, and now we don't need to own it. And like, hey, why would I want to own gold if it's just money? And we just know I can just print the money now. Why own it? And so central banks around the world actually kind of had some collusion that they said, hey, we'll all slowly sell our gold to everyone. We're not going to dump it on the market, because then, what happens with supply and demand, right? They would be, robbing themselves of it. So they bleed it out in the market. And so throughout the 80s and 90s, you have this whole period where, like, gold gets really, really cheap, historically cheap, actually, particularly if you measure it against, like, oil, price of oil. And it actually, funny enough, by the time you got to the late 90s, if there was a saying, like, the only reason you put gold in the portfolio is if you're interested in losing money. And so if you actually take out this period of time of, like, gold standard plus, coming off the gold standard, you say, how has gold done since? Gold's beaten the S&P 500. How is that possible? Right? As of right now, gold is it has, since the early 2000s, is performed as well, if not better, than the biggest, baddest stock market index out there. And I had a hard time with this, actually, as I learned about it. And one of the things that I came to realize and think about, and the thing that I use as an example that's most relatable and really, like, made it click for me, was this idea around TVs. Right. Yeah. And so I've talked about this before on the podcast, but remember, like, we live in this world, and this always seems, people can get so mad when I say this. We live in a both inflationary and deflationary world.
Yep.
So there's this constant inflationary pressure in the money supply, but there's this constant deflationary pressure as a result of technology, right?
Mm-hmm.
It's cheaper to produce agriculture now. It's way more efficient, right?
Yeah.
It's way more efficient to do a lot of these things. Yet the price of it goes up nominally. So if you can actually protect your purchasing power and then allow the technology to do the deflationary effects, you end up being able to buy more with your preserved purchasing power.
Yeah.
So this manifest is like the easiest way to see this is to say, how many ounces of gold would it have bought to buy a TV 10, 15 years ago, right?
Yeah.
In 2010, to buy a flat screen 55-inch TV in the normal living room in America, it would have been like, $1,200 maybe. Like, I don't know, somebody go pull the price on this for me. But what I know is that when I graduated high school, it was a luxury for families to have a 55-inch flat screen TV in their house. That was not something everybody had, right? And I remember actually like moving out and going to college and I tried to get a 32-inch TV. It wasn't even really flat, but that was like a couple $100, right? At a used,
Yeah.
Like I bought it at a pawn shop. And fast forward, now 2 or 3 years ago when we got our new office in St. George, I had to buy like 5 TVs for the office. And I just got on Costco and 55-inch flat screen TVs, $200, boom, delivered right to the door.
Yeah.
And so like what gives? Because that's post-COVID and man, inflation's up and everything's more expensive, blah, 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 blah. Yet here's a TV that's
So
down
much
in
less
price.
expensive.
In dollar terms, even it's down significantly, right? Food might be up, but in dollar terms, even it is. And so if you start looking at, man, like what was the price of gold? How many ounces of gold? And so like housing is another good example. I've done this a number of times. If you go and look at price of gold in the past and how many ounces of gold would have taken to buy a house and how many ounces of gold would it take to buy a house now, like, why is it less? Well, because homes depreciate and it's also cheaper to build a home now than it was, right? Like it's faster. It's they can cut timber faster, more economically, right? Like
the resources are more available.
It all passes through. So the land value sure might go up and the dollar amount might go up, but in terms of gold, it gets cheaper. Now, and we talked about this in the real estate episode, is you don't just buy gold instead of real estate because they have different characteristics.
Yeah.
But that's the kind of thing that gold brings to the table. Now, fundamentally, one of the things that gold, there is an interesting thing about gold though to understand, and that's that there can be more. So let's talk about like the cons of gold.
Okay.
Where does gold go wrong?
Well, I mean, when we're talking about investments, and you already mentioned this, but there's no yield, right? So that's one thing to consider. It's just that storage of value. You're not getting dividends. You're not getting additional interest or growth on
it. It is
that,
speculative
right?
in nature in that the value of gold is simply what the next person's willing to pay you for it.
Yeah.
There's zero endogenous return on gold.
Yeah.
Now, as an example of that, if you can look at this year, gold has had one of the most incredible years, actually probably the most incredible year it's ever had. And yet if you look from April until mid-August this year, like April, I think it topped at like April 20th. And I think it broke out at like August 18th, I think. So you're talking like a clean, what is that, four months?
Yeah.
It just went up and down and up and down and up and down. And it was in what we would call a trading range. But it moved nowhere. It just went completely sideways. And so 4 or 5 months, you look at it and go, I haven't made any, my investment hasn't gone anywhere, Oh man, is this thing ever going to go up? Oh man, look, it went down. Oh, it went up. It went down. This thing is just a waste of time. And then all of a sudden it went, and printed money for, it printed money for several weeks. And then it went totally parabolic. And then now this week, last week and this week, we've seen some major drawdown. We went from 4,500 to 4,000, which is, you're going to have probably a 10% correction in gold. And that's is actually really bullish in my opinion for gold. I think it needs to happen in order for gold to continue to be what it is, right? If gold just goes to $1 million next month, we've got a problem.
Yeah.
and probably a problem way faster than I was able to prepare for it, anyways, but that makes it very uncomfortable investment to hold sometimes, right? Because if you have an investment that just goes kind of nowhere for a year or two, you might get bored, right? And it's really tempting as investors to get bored if you're kind of constantly not going in the right direction, right? You want to see an account number sort of grow. And so that becomes a risk. Like there's this behavioral risk of gold. And there's certainly like the behavioral aspect that, it's not behavioral. Because the return of gold is entirely exogenous. And that's to say that it's not inherently producing you anything, right?
Yeah.
And this is true of any commodity, just fine. There's nothing wrong with that as an investment profile. It's just to what degree do you care for that or need that in your investment thesis? Well, I sort of look at gold and say, currently, over an extended period of time, the endogenous return is actually somewhat provided to you by Congress and their lack of ability to control spending, the Federal Reserve and their, lack of being able to just say, look, the inflation target's 0%, right? Yeah. They say, hey, 2%. Well, when they say, hey, there's 2% inflation, to me, that sort of almost translates to, and it's not perfect, right? Like, and I'll probably catch some flack for saying this, but it kind of gives gold almost like a 2% yield over time.
Yeah.
At a minimum, right? Like you're kind of like, okay.
Okay. Yeah.
Now, I suppose you can make the argument that tips are still better. And I know that there's not a shortage of financial planners out there that will make that argument. I would just go back and just argue, okay, well, come off of, 2000 after we had bled out all that supply of central banks coming off the gold standard. And what's them better, tips or
gold?
Or gold. And the disparity is astronomically different, right? So, now I tend to view that from the lens that I'm a real person that lives in the real economy. And, although I spend a lot of my time staring at computer screens and doing nerd math, I also still go out into the real economy and buy things, right? Yeah. And I still pay utility bills. I'm still a relatively normal person. And so when you go and say, well, inflation's only running at 2.5% now. And I go, well, beef is up 80% and my energy bill is double and fuel is more expensive and all of these things that I have to truly buy. My inflation rate in my personal economy isn't 2.5 or 3%. It sure as heck isn't, right?
Yeah.
And so I have to just sort of question and say, well, tips might be linked to the official inflation number.
Yeah.
But, show me there's an old,
how are they adjusting?
There's an old Charlie Munger quote, right? Show me the incentives and I'll tell you the outcomes.
Yeah.
And what I know and what anyone can observe is that there's future funding obligations by the federal government that they have to pay people out that are linked to inflation, right? Namely, Social Security, right?
Yeah.
Is probably the biggest one. And then you have some things that are linked to inflation, like Medicare. However, like interestingly enough, that's linked to really the cost of the inflation of medical inflation, right?
Yeah.
Healthcare inflation. That's the word I was looking for. But remember, they have to pay that over time. So there's an incentive. Well, if we can make that number, be ever so slightly less than what the real numbers are that people are experiencing, right? If we can choose to calculate that index in such a way that's going to be most favorable for us and least favorable for everyone else, what you end up with is people. And look, I'm going to say this and you're going to say, that sounds really familiar. And it's people saying, man, Social Security doesn't feel like it cuts it anymore.
Yep. Hey,
they gave me 4% more on Social Security, but I just can't. It's so expensive. It's getting so expensive. Well, there's a reason why, even though we have these things that are wages are going up with inflation, yet people are struggling, right?
Yeah.
Now, if you own a lot of assets, you're not struggling.
Yeah.
But if you're on Main Street, it's been tough for you the last couple of years, most likely, right? And I'm in tune with that. And so that's where I think if you're over allocated to tips, and I'm going to say this, like, I'm going to preface this, like, as a Main Street investor, right?
Yeah.
That's who we deal with, right? Now, if you're a big organization, right? I have friends that manage pension funds, or they're very wealthy, or they work in family offices. That's a different scenario, right? Where because you're trying to liability match certain things, right? And you have a plethora of assets and things working and going, and you have access to unique tools. Like, I'm not saying tips are inherently bad for everything, but for Main Street investor, if you're trying to weather this economic cycle,
it may not be the best solution.
I would be, I'm going to issue some caution around, being allocated to tips for any kind of extended period of time.
Yeah.
Now, as a tactical trade, like everyone that knows me knows, I am not above any tactical trade, right?
Yeah.
I will interest rates, tips, gold, Bitcoin, small cap stock, large cap stock, international, China, commodities, whatever, right? I'll trade anything. If I think that I've got an edge, I've got a setup, right? Like anything can work for a couple weeks or a couple months. It's the question around, can it work for 10 years?
Yeah.
Can it work for 15 years? Can it work for 20 years? Yeah. And so if you prescribe to something that's, or buy and hold, or a portion of your portfolio that's buy and hold, I'd really be, cautious around the use of tips or bonds as a way to protect against inflation, rather than some of these other assets that tend to do a lot better in inflationary environments.
So if we talk about how gold can act as a hedge against inflation, right, and debasement, because that's really what this conversation's around is, I think a lot of people have misunderstandings about the ways that are available to own gold, or to have gold as part of their portfolio, and some of the pros and the cons to that. Can we talk about that for just a minute? Because I do think that there are some people out there that are still stuck on like that physical gold mentality of owning gold, and like that's the only way that you can or should have it. And I would say that there's a lot of considerations to that. There's a lot of negatives.
You just showed up and wanted to hit my hot buttons, huh? So here's the biggest thing is if somebody's talking to you about gold or silver or precious metals or whatever, right?
Yeah.
And there is two red flags that you are about to make a major financial error that you need to pause, and go take a cold shower and calm down. And that is if you hear self-directed IRA, okay? That's the first one. That's like don't turn around and walk, turn around and run, okay? And the second one is if you hear somebody say paper shares, right?
Mm-hmm.
So there is what I'm going to call, it's not legally a scam, but it's basically about as much as a scam as I think it gets. Companies that sell people this idea of owning physical gold and silver in some kind of vault or secure facility or whatever, right? And it's this big, like, you get a statement from them that says you own X number of shares. Alternatively, like what we buy for clients is physical gold. It's through a trust. It has a legal framework that's very transparent.
Yeah. And
the trust owns one thing, physical gold, that's in a vault and audited by third parties to verify that all it is gold in a vault, and you own that via owning shares of the trust, right? And the trust can't make it go away. The trust can't like steal it, right? Yeah. It's physical gold, and you can audit that. And so like, why is it such a joke when these people say like, well, it's paper shares? Well, because sure, but you're holding something and you're issuing paper shares. It just says, instead of shares, it says ounces. Mm-hmm. So a statement from Charles Schwab might say, shares, you can convert it to ounces if you want. Like, you can do the calculation. But at the end of the day, it's physical metal held in a vault. One is audited, very transparent, and one of the largest, some of the largest trusts in the world, in some of the most secure locations that if that goes down, we got way bigger problems than what the balance is in your accounts, right? And the other one is just some, small mom and pop operation somewhere that is going to charge you more. On average, what I found is 5 times the cost.
I was going to say, I think that's one of the biggest things I wanted to point out is the difference in cost based on the way that you own.
On just the annual expenses, more than 5 times on average. And there's typically a premium to buy and a premium to sell.
Yeah.
Okay. So you're
the vault storage
which means
costs.
you're paying a fee on the way in, a fee on the way out. You're paying 5 times on average on the storage cost. And if the world really goes to hell in a handbasket to the point that you want physical gold and silver, and you got some coins in some vault in another state, good luck having that guy hand them over on.
Yeah.
You know what I mean? Come on, let's get real with ourselves. So if that's your thesis, right, there's only one way to do it, and that's own physical gold and silver in your possession. Be my guest. It has a carrying cost though still, right?
Oh, absolutely.
You got now the carrying cost might be the cheapest. You don't have to keep it, lit. You don't have to keep a security system on it. You don't have to do any of that stuff, right? You can buy a gold coin. You can put it in your safe at the house or whatever. Just realize you take on, going back to our conversations around risk, different kinds of risk. And from a wealth management advisor, it's my job to point out a couple of these, which although they sound maybe silly on their face, they're real, which is, look, if all you have is $5,000, look, what you can afford is one gold coin, like you're in a different scenario. We tend to deal with people that like their allocations can be 50, 100,000, 300,000, $500,000.
Yeah.
And all of a sudden, if you have that kind of gold and you want to sell some and you want to cash out, you need to take $500,000 of gold in your pocket down to the pawn shop. Better hope no one knows that's what you're doing. That's a huge safety risk, right? Yeah. And on top of that, then you're going to pay a premium again to buy and a premium to sell.
Yep.
And so you get shortchanged there. And then you just have this risk that like if somebody knows you have it and they can come take it, right? Like that's, for what it's worth, that's Aaron's big argument about Bitcoin, right? You can't come take it from me,
Yeah.
Well, it's really hard for somebody to steal that out of my, brokerage account if I own shares in something. Not impossible. Like, anything in this world is sort of possible, right?
Yeah.
It's kind of always my thesis. But it's more secure. And then too, it's more tax efficient. I think it's the feasibility around tax efficiency is actually really big, especially if you own it in a brokerage account, right? So if you self-directing anything like that is just a nightmare. Your accountant is going to really not be pleased with your decisions.
It's going to cost you more for your tax returns.
You are not going to be pleased with your decisions in the long run when you try to deal with those companies. I have tried it. It's a nightmare typically.
It is awful.
It is just awful. And I have seen people get so frustrated. They are screaming in phones. And they can't understand why they're paying fees and this and that. It's not supposed to be that, but it is. But you really can't tell them to stuff it because they're doing your IRS reporting on this self-directed IRA. And so you can't just decouple from them. And it's a whole mess. And to unwind from them, you usually have to first unwind your physical gold position or wherever you got that. And it's a whole process. But zeroing in on like a brokerage account, like we do a lot with people with their tax planning and we have a lot of clients that are charitably minded people. Like we'll take their gold and we'll do their charitable giving to their charitable organizations and say, hey, we're going to donate these appreciated shares of a gold trust to that organization. And in doing so, they don't have to realize their long-term capital gains.
Yeah.
Right. Which saves them a lot of money on taxes. And now the cash that they were going to use to give that organization, they just go and just buy more gold.
Yeah.
Right. And so you have this ability to be more tax efficient. Hey, it's no secret to us. We look at the demographics of this show. We know that a lot of you listening are actually other financial professionals and other investment advisors. We want to go ahead and invite you. If you're looking to do something different in your career, go ahead and reach out. We're always looking to bring on high quality people that understand how to do the planning process, align with our values, and are looking to deliver high value to their clients. Please just go ahead and reach out to us. You can get us on our website, ducharmewealth.com, and we look forward to talking to you. The other piece that a lot of our clients utilize is actually pledging it as collateral.
Yeah.
So when you have a sizable amount when you have a sizable portfolio, it's very easy actually at like we custody at Charles Schwab, and say, hey, I've got $500,000 in gold, Charles Schwab. What do you say I pledge that as collateral? And they'll give you about $375,000 of instant collateral against it, 70% of your value, right? So if you have $1 million in gold, you buy $1 million in gold today, and you say, man, gold's going up over the next 2-3 years, like 10-15% a year. But all of a sudden you have a short-term funding need.
Yeah.
Well, when gold moves, it can move really quick. And so you say, well, I don't want to sell it. I want to make sure I own this so I don't miss out on if it starts to run. But I've got to finish up a project. I've got a short-term funding need for my business. I'm going to flip a house. I'm going to, right? You can borrow money from Charles Schwab on $1 million worth of gold. You can borrow like $700,000 immediately, and you get relatively favorable terms on the financing, right?
Yeah.
And so it's sort of easy to access some liquidity that way. But if it's in some weird one-off, or it's coins in your vault, remember, you can't walk into the bank and say, I promise I've got the coins. Would you please give me a loan?
Yeah.
Right?
Yeah,
it's just not how it works.
They're just going to laugh at you.
Yeah. So there's that unique advantage to you when you're at Schwab,
Yeah.
or any major custodian that offers, pledge asset lines.
Another one that I have not heard much about outside of, certain people have talked about it, but it's not as generally or widely known. But gold miners, and the opportunity to own gold through gold miners.
Yeah, that's it. Yeah, so that's like gold exposure, but that brings up a good point about gold, which is the incentive structure around it, right? So, one of the unique aspects of gold is that if the price of gold gets too high, i.e., the money gets too expensive, there's an incentive for people to figure out how to go find more of it, right? Which is in gold. Look, there's really like 3 ways to do this, right? There's like figure out how to mine it, get it out of space. And that's where gold came from originally, is according to science. You can figure out how to convert other atoms, or using chemistry, or I don't know if that would probably be alchemy. I don't know. I'm not a chemist, but you figure out how to convert something to gold, right? Like, the same idea that they figured out how to convert, coal to diamonds. Yeah. There's this theory out there of potentially being able to turn stuff into gold. I don't know when or where, why or how, or I don't know any of that. But like, if it gets expensive enough, like believe me, innovation will chase that and sort of solve for the problem. And the most common one though is just mine some more of it out of the ground, right? It's in there somewhere, and you go find it. And at first it was easy to mine for gold, right? You'd walk along the riverbanks and you pick it up.
The California gold rush.
And then you had to dig for it a little bit. Now you got to dig deeper and deeper, and there's less and less, and there's this diminishing returns. But as gold gets more expensive, it becomes more profitable or lucrative to actually go out and say, well, we're going to get this whole truckload of earth out of the ground to get one tiny little, speck of gold. But that one tiny little speck is worth enough that it's worth it to run this whole operation. Yeah. Right? And so the price of gold tends to be very good for gold miners. The other thing that tends to be really good for gold miners is low oil cost, which we've seen this year. But there is an incentive for gold to be managed correctly. Now, this is the argument of Bitcoiners, and we'll talk about this more with Aaron in the next episode. And I think the number Aaron says normally is about 2 to 3% of gold supply increase per year via mining. I don't know what the data is on that. I probably want to ask him where he got that data. Anyway, so Bitcoin will say, well, there's this limited supply of Bitcoin, whereas you can't ever prove that the world is sort of out of new gold to bring out of the ground.
There's a scarcity, but it's not a finite amount, I guess.
Well, and I would argue that it is a finite amount.
We just don't know what that amount is.
You don't know what it is. If you put this into Bitcoin terminology, you really don't know if it's 21 million or if it's 24 million coins, right? You kind of just don't. At some point, you probably know through some degree of certainty, that gold is not as plentiful as lead or copper. Okay. Like,
Okay.
You don't start digging, 100 feet down in Russia and the entire continent or your entire country is all gold, right?
Yeah. Which I guess again leads to the value difference
right.
between the gold and the copper and things
Yeah,
like that.
it's generally scarce, and I think there's less and less coming out of the ground, and it's tougher to find and get. But nonetheless, it's there. A lot of it is like there, it's there, but it costs. If they look at it and they say, well, it's going to cost us $5,000 an ounce to get that part out of the ground that we know is sort of down there somewhere. It just doesn't make sense to go get it until gold's at $7,000 or $8,000 an ounce.
Right.
That's just how the economics work of it. Right. So, as those supplies come online at some point in the future, I don't know. But gold mines is an interesting way to get particularly like leverage exposure. It tends to move about 1.5 times as dramatic as gold.
I guess that just kind of leads into my question, or where I was trying to lead into, is like where there are these different types or different ways to get access to gold in a portfolio. Is there a difference in how they're able to hedge against the debasement? Or is it just gold in general?
The mining companies, or
well, like just the different ways of accessing gold, or is it just
if you look at gold mines, you're kind of combining two of the main, you're kind of combining two of the concepts, which is precious metals, right? Which because you own it via it's in the ground, right? Like it's just like owning it in your safe, maybe, but it's like in the ground. It just hasn't come out of the ground yet. But if you own the mine, you sort of own the gold that's in the mine, right?
Yeah.
Some nuances in mining in the way that you maybe lease mines rather than own them,
right?
In certain countries. And anyways, some nuanced conversation there. But in general, as a concept, if you think about it, like you own the gold that's in the ground. Now, as a result, though, you now also are taking a lot of the principles of real estate. Because what do you own? You don't really own gold. You own real estate. So gold mines are a physical piece of real estate somewhere, right?
Yeah.
And you're going to employ some of the other financial concepts like leverage via operating capital, sale of equity, debt financing, right? These sorts of things that, I mean, look, and it's just normal operations that companies do. This isn't like a fringe thing. It's how companies operate, right? But because of that is why, it's riskier, right? Or potentially more risk. I mean, how do you define risk, right? That's a whole different conversation. But one might say it's more volatile for sure than owning like physical gold.
Okay.
And it's because you own the gold, but you also own the business operation. Well, with that capital efficiency or the leverage or the operating nature of that becomes the variability around the outcome, right?
Yeah.
Which is, hey, we own a lot. You could be sitting on a gold mine that's like, hey, we own a ton of gold, but it's not worth it to ever pull it out of the ground until the price gets to $7,000 an ounce.
Right.
And then we've got a lot of gold, right? Well, that's a totally different outcome than just like, we own a bunch of gold, right? Because what if it takes a couple of years to get there? Well, in the meantime, the gold mine still has to pay their employees and operate trucks and pay for insurances and, all these things, right? So there's a negative carry, there's a cost of the debt financing. And so that all plays through in the price of gold mines. Is a word of caution if somebody's going to get involved in that space without professional help. It is notoriously one of the worst run sectors from a management perspective. You don't really have a lot of like Steve Jobs running gold mines. There's a lot of mismanagement. So generally the way that like we work this when we're doing portfolios or putting on trades is we tend to sort of say like the same idea as stocks. It's really hard to pick, like the winning stocks.
Yeah.
And so we buy the index. You kind of buy the gold mine index typically. And you kind of just hold your nose a little bit and say, I know there's some stuff that's really not maybe the greatest, but the only way to get the great stuff is to maybe just take on the risk of owning some of the stuff that's less savory. And you want that general macro exposure.
Okay.
We're a macro shop. It's kind of what we tend to do. No shame in that game. Also no shame in the game if you're a fundamentalist and, you deeply understand gold mines and you're picking. There are some people out there that do that. And man, the moves in those companies when they come online, can be crazy, both to the upside and the downside, right? So like if you see all of a sudden, I know that there was a mine down in Panama and all of a sudden Panama shuts it down. Well, you have a great stock, a great performing company, a great performing stock. Not through no fault of their own, like the price of the stock falls through the floor because Panama government just shut something down, you know? So there's a lot of nuances you got to understand, but there's fundamental, there's fundamental analysts out there that deeply understand the sector and do that kind of research. And it is such a small sector that there is some dislocation and inefficiencies that I think there's probably an opportunity for active management if you find one of those managers. I'm certainly not that person, but that's my word of caution around mines. The regular mines are one thing. The juniors are, sort of even worse, more exacerbated, right? Junior mines, smaller, more speculative. A lot of them might have, they might own it. It might be proven, but operations haven't even started, or operations are halted, or it's just a really small operation. So the variability, right? That's like where a manager change can make a huge difference, both up and down. So you get more of that beta exposure, but when it's running to the upside, sometimes you want that, right? I mean, and that goes true for really all the mining sectors, right? So whether it's gold or silver mines or uranium mines or whatever, right?
Yeah.
This is not an episode about the fundamental nature of mines, though.
Sorry, we kind of went off topic a little bit, but I guess bringing it back, the whole idea behind the precious metals being a hedge against debasement for the U.S. currency in general is the idea that when currencies are weakening, or when the U.S. currency is weakening, the dollar, then gold is strengthening.
Yeah, that's a really interesting thought. And the way that we phrase this really matters, and the way that people phrase it really matters. And the reason why is because when you talk about the dollar, you really have to delineate, okay, am I talking about the dollar bill in my pocket and what I can buy in the U.S. as somebody that lives their life in U.S. dollars today, right? Like can this dollar in my pocket still buy a water bottle, right?
Yeah.
Say. And so is that getting weaker or that getting stronger? And when we talk about debasement, we're generally talking about that getting weaker.
Right.
And so we might say, well, dollars weaken over time and purchasing power, and there's this debasement.
Not necessarily in relation to other.
Well, what's interesting is if you talk about in finance in particular, if you talk about the dollar, you're generally talking about the dollar index, or sometimes or often referred to as what they call the Dixie. Then the reason why is a symbol on it is DXY. Yeah. So the Dixie index. And that is a currency where or not a currency, an index where you're really not, you can't really be like long dollar, because to be truly long dollar, it just means that you're like, you either own an asset that's priced in dollars, or even more purely, like you just own dollar bills like in your pocket, right? Because even if you own treasuries, you're long treasuries, right? Yeah. So like actual cash is being like long dollar. Well, everyone knows that that's kind of a silly thing to be over an extended period of time. But what's the deal with this whole dollar thing for like the dollar index of the Dixie is you're actually short other currencies. And there's some nuances around explaining like forwards contracts and how that works. But essentially you sell dollars would be the term. Or you would sell other currencies that you don't actually have, right? So you're effectively short. And that index it's essentially sell this basket of foreign currencies to buy dollars via forwards contracts. Those currencies are largely the Eurozone currencies and the Japanese yen. That would be the largest components of that. And so what's interesting is there's these periods, like last year was a really great example where people might come out and say the dollar is getting wrecked, Yeah. And so in the U.S., this is like this. If you live in Europe, this was not something you were hearing last year. But if you live in the U.S., people would say this, man, inflation's so high, the dollar sucks, blah, 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 blah. Well, the dollar is the dollar. It's kind of like there's a saying in finance, it's the cleanest shirt in the dirty laundry. And what that means is it's the best of the crappy fiat currencies out there. And so last year you saw two things happen alongside each other that is somewhat rare, but was really important and crucial. And that's like the price of gold went up last year, somewhat significantly last year as well. But the dollar rose in purchasing power significantly. It topped out about 113 on the index, which means like last year, your trip to Europe was pretty cheap.
Yeah.
Now, what's interesting is gold is priced in dollars. And so what you actually saw as that was happening is gold priced not in dollars the way that we perceive it, but gold priced in all the other currencies around the world was like breaking out to like massive it was ripping, all new all-time highs early in the year last year. And it was good. It was still going higher in US terms. And then all of a sudden, like the dollar gets relatively weak this year. Well, okay, that has some implications on stocks and equities, especially foreign equities. But all of a sudden, like that does make room for gold to then push a lot higher. And so there's this difference between the gold dollar cross, right? Which is like how many ounces of gold per how many dollars?
Yeah.
And is the dollar weaker? Is the dollar strong? If you're talking about it in terms of the global financial system, right? Because you could have this period where the dollar is strong relative to all the other currencies, but still really weak to gold.
Yes.
Right. So it depends if you're putting in a framework, like, are you viewing gold as a commodity or are you viewing gold as a currency?
Gotcha. And
that changes the way that you sort of look at the trade, the environment, the system, right?
I think that's a really important call out.
Yeah. To tag onto that, I will also issue a word of caution, which is that silver, although it has a lot of these characteristics, and we might talk about it like, oh, poor man's gold, or whatever. Or some people will say like, oh, silver's a leverage play on the dollar, leverage play on gold. Those things can be like sort of true. It's kind of like more anecdotal though. Silver still largely trades like a commodity. So maybe some of the same fundamental drivers that drive gold can drive silver, right? But it still trades like a commodity. And so you have to be really careful getting too involved in silver, too overextended. And that's not bad for it to still trade like a commodity. In fact, you can get some diversification now from owning both gold and silver. Just be aware of what it is, how it works, why it moves the way it does, and kind of some of these things. And if you don't, it might be best to either buy a small amount that the volatility doesn't matter to you, right? Or make sure that you're maybe hiring a professional that has some kind of experience around that to put in your portfolio.
Yeah.
I wouldn't recommend most people call up their advisor and say, you know what, put a bunch of silver in my portfolio because the volatility can rip your face off, candidly. It really can. Although we can think of silver as a relatively safe investment, if you zoom out, blah, 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 blah. I mean, silver just now, like last week, 2 weeks ago, broke its all-time high from the 80s. So like buyer be warned, silver can go much higher from here and very well could. But silver also could trade a lot lower right now, right? And it doesn't have the same kind of foreign currency aspect to it that gold does. And so because of that volatility range can be a lot more pronounced and not in step, not kind of synced in step with gold, right? So it's not just like having higher, like more gold. It is a little different. And at times it can make you scratch your head a little bit. And so having too much of it, if you just call an advisor, you don't understand silver and you just say, you know what, like, I put 20% of my portfolio in silver and it goes down 20, 30, 40% or something, you're going to be feeling really uncomfortable. And you probably want an advisor that can talk you through what might be happening and whether it's time to sell or not, or, what's going on. So, because remember, like the underlying thing on this whole debasement thing is like, at some point, although it's a really uncomfortable thought, is like, at some point you have to sell.
Yeah. Right.
And whether that's because eventually you come to the end of a debasement cycle, right? You have what they call the blow off top. You want to capture that gain at the end. But also like there's sub cycles within the cycles that are very uncomfortable and could be life changing from a financial perspective because we're still humans and we still need to access capital in the midterm. Yeah. Right. So we can say, and this, I always remind people this, it's really easy to say, oh, hey, look, like not to date myself on how young I am here, but I'm 31 years old. It's really easy for me to come to the table and say, well, my time horizon's 36 years. I'm not going to be full Social Security retirement age for 36 years. I won't need to touch that money for all those years. it's like, yeah, that sounds nice. Like when you're in the meeting, but it's kind of like going into the doctor and being like, nope, never drink, would never do it. And you're like, yeah, dude, until you're at that party or whatever. And now all of a sudden life changes a little bit and you have some social pressures. Well, the financial markets change, your life circumstances change. And there's a lot of people, and I only say this not like anecdotally, but because I observed it as a child and was really around the family business in sort of the dot-com era and '08. And, my dad did well for people and people appreciate my dad. And there was not a shortage of people when I was a kid that would tell me what was going on and how my dad was helping them through it and whatever. And, people opened up for whatever reason, I'm like a little kid. But look, like you lose your job, there's a lot of people that in the late 90s thought they were long-term investors. But after the dot-com, in a mild recession there, and then '08 happening, all of a sudden they're in 2009. It's the bottom of the market. They've been unemployed for 6, 7, 8 months already. They're out of savings and they got to use the 401k, right? Like you start using the 401k or sell that, or foreclose on the house. And guess what the decision is? It's going to be, dip into the IRA, the 401k fund. So all of a sudden life can change. That long-term money becomes midterm or short-term money relatively quick. And that's why it's important to have the diversification of the asset classes, right? Although I think gold, silver, platinum, palladium can have these exceptional returns over time relative to the true risk you're taking, in my opinion. In the short term, the volatility risk can be detrimental to you if that's the only thing you have, right? It's the same with real estate. It's the same with Bitcoin. It's the same with stocks. It's the same with anything. And that's why the diversification matters so much when we're having this conversation, that you need, in our framework, we use 5 asset categories that we think are going to go to the same place in the end, right? Generally. But they're going to take some different paths to get there. And so you have the opportunity to maybe liquidate different things at different times if life happens along the way. And we're also really big fans of doing the financial planning to say, how do we insulate you in the short and midterm so that you're not taking disastrous results in the midterm and being forced into accepting that as a result, right? And lock that in. So, that's the teaser around what will end up being the bonus episode on this. Like, how do you think through some of that planning? But financial planning is really important to marry with all of this discussion.
Absolutely.
So, you get me going on all this stuff, Carissa. Like,
I know all the hot points, the trigger.
Yeah. Yes. Yeah, you do. You hear me ranting in the office a lot. You kind of, anyways.
So sorry for our listeners if that wasn't what you were looking for, but I do think it's pretty interesting to understand some of these different areas and concepts that we don't hear a whole lot about out there. So, thanks for.
Now you got me going on another concept, right?
Well, I think
another idea. We got to wrap this up. This is the last one. You brought up something though that's important, which is a lot of places don't talk about this. We don't talk about this a lot. It's not commonly talked about. And here's really the truth why is that a lot of these markets that we're looking at and a lot of these ideas we're looking at and a lot of the trades that we put on or the way that we intend on trade something, you can't do it if you're a big shop. You can't do it if you're not boutique. And the reason why is that the markets aren't exactly huge, right? So if you're a large, huge bank that has billions or trillions of dollars under management, you can't just go out and say, you know what we want to do? We want to do a 5% allocation of every client's portfolio to this one idea. But by the way, that 5% allocation is twice as much of that thing that exists in totality.
So it's going to move the market.
It entirely moves the market. And so they're just completely constrained. And so that's why you have these big box shops that tend to tell all of their clients the same thing, which is like, you need a little bit of everything and you need this. And so you get the cookie cutter thing because like if they deviate from that, they don't have a business model anymore. Yeah. They're too big. They have no ability to be nimble or to put a certain trade on or manage a certain risk or really seek that. Like that is a huge advantage that we have as a smaller firm. And it is to be able to do that. I mean, I can put on trades and almost never have to think about am I going to move the market with this trade? Very, very rarely do I have to work my way into a trade or work my way out of a trade because it's large enough that it would potentially move markets. It's very uncommon for us to deal with that. And that's a big advantage. But that's why I truly believe that is why it's not talked about more. It's not because it's wrong.
I would agree with that.
It's not because I'm
or like, it's new or
and I know this because when I get in circles of high quality fund managers, institutional managers, academics, really high quality economists. I mean, these people, and it's kind of always have this thought of like, hey, am I crazy on this? And they go like, oh, no, you're not crazy.
Yeah.
Not at all. I'm like, why isn't that the call? And it took me a while to just realize like, because they can't make that the call. Right. So
yeah,
take that for what it's worth. But I do take pride in the fact that our smaller nature relative to big, well-known shops is a huge structural advantage for us.
Absolutely. Yeah.
So, and by proxy, our clients. So, anyways, thanks for coming in. Thanks everyone for tuning in. I know these episodes probably are getting to be a lot on people. It's a lot to think about, this debasement stuff. But I'm really passionate about it because I think it's something that people, again, don't talk enough about. They don't understand it enough. And so we get shaken out by all this stuff, all the noise in the present, right? And sometimes we have to have a larger framework to cut through that noise, do the planning and move through life and try to reach our financial goals on time with meaning and purpose. And you need a good framework to execute on that. So, I think we have a solid framework, and I'm passionate about sharing it with everyone. So, next episode up is going to be a Bitcoin. Love it, hate it. I kind of know both sides. I've got I've got some interesting points on the whole thing and thoughts. If you want to go back and listen to the first 2 Bitcoin episodes we did, I did a bull bear kind of episode. A friend of mine, Mike Green, very bearish on Bitcoin, and a very smart guy. And I think he's right. And I did one with Aaron Olson, who's a Bitcoin maxi as they come. And I think in a lot of ways he's right. And Aaron will be coming actually back as a guest, or he's supposed to, barring a scheduling conflict or something. But he right now it's on the calendar for him to come back. And what's interesting is Mike and Aaron almost agree. It's just a perception of what's right and wrong, and where do you sort of end the timeline is maybe what I'll say. But I'm a technician, so I just like owning things that go up. And when they don't, I don't really care to own them. So take that for what it's worth. And we will see y'all on the Bitcoin episode. If you have any questions in the meantime, reach out. Find us at ducharmewealth.com.
Yep.
Find me on X. I'm on there posting stuff all the time. Obviously know where our YouTube channel and our Spotify and RSS feed is at. Reach out though. Any questions, we're happy to answer them. If you have any questions about Bitcoin or crypto that you want us to specifically address in that episode, send us a message right away. We're happy to try to address that directly in that episode. And we will see you guys all out there. Bye.